start off, we're going to take a bit of a look at what the industry's been doing, and there's probably no better man to do it, or men, than Stephen Hamilton, Director of Horworth HTL. But first up, Paul Hammond, the Business Development Manager, STR, who's going to give us a bit of a view of what's been happening in the New Zealand market. Please welcome the first speaker of Maximum Occupancy 2022, Paul Hammond. Thank you.
Good morning, kia ora. G'day. Great to be back in the company of Kiwi colleagues and mates. Thank you so much, Adrian and the Maximum Occupancy New Zealand team, for the opportunity to present with you all today. I'm just going to give you a quick 15-minute rundown, and then I'm going to kick on to Stephen. But first, I just wanted to open up with a little bit of a video to sort of set the mood, if you like, on what's been happening of recent times. So sit back and relax and take it in. There we have it, just to hopefully give you a little bit of a snapshot view on some of the trends, some of the things that no doubt you're seeing and hearing in your own performance activity in regions. So firstly, as usual with STR, we like to give a bit of a global perspective. So let's start off with some international insights. So we can see here for global markets, and I'm just going to make a pre-note here that I'm going to do a lot of comparisons to 2019 or pre-pandemic performance levels to give some perspective there on how things are tracking in this current time. So if we look at this, we're looking at indexing, and we're looking at year-to-date occupancy in terms of where it's indexed to 2019 levels. You can see for the most part, most regions are looking at 80 or above index levels, and some even above 90 in that space. You can see obviously the standout there of China and Asia still somewhat struggling that 70 upwards mark, and there's insights into that which I'll come to later, but obviously the China COVID zero policy is certainly having its play there. And then looking by contrast at the average daily rate or ADR levels globally, the smaller circles are showing you year to date, and the bigger circles, the darker blue, are showing you the current month of June. And again, you can see the contrast there, particularly the contrast of mainland China and Asia and the impacts of what's been happening there in recent months. But by contrast, that enormous growth that's been happening worldwide, and obviously it's been the story that's been happening here, of course, locally here in New Zealand as well. Then taking our global stance or perspective outside of US markets, this is all non-US markets, looking at a week to week from the last 12 months, from last July. And what we're looking at here is we're seeing that there's a steady progression away from that depression and recovery side of things and into a much more recovery and peak stage. Those purple and greens are starting to really strengthen, which is the retrospective of regions like Australia, New Zealand, and the like. So looking more locally, let's have a look at what's happening here in New Zealand. So you can obviously see here that in recent months, there's been a positive trajectory. But again, indexing that to a 2019 or pre-pandemic perspective, we're still looking at an index of around 80. In absolute value terms, that looks at about just over 50% in absolute average occupancy for the month of June, for example. So it's about 20 points away from where we were in 2019, but still that trajectory is what's happening, is the underpinning. But you can see by contrast, when compared to somewhere like Australia, Australia is very close to being back to where they were in terms of pre-pandemic levels in that 90 plus index level. And why is this? Well, occupancy levels do vary from one destination to another, of course. There's lots of variables to this. There's seasonality, lots of different sporting events, conference events. Wellington's a great example of what happened in recent weeks with the rugby. I won't want to make that a sore point, but obviously that's an event that drove enormous demand for Wellington, with not just occupancy, but also in average daily rates. And we'll come to that a little bit more as we go along. But there's these sorts of things which are underpinning the performance in recent times for New Zealand and that recovery, so much to speak, particularly when it comes to seasonality and events as well. On the flip side, or the other side of the coin of that, is there's also a return of supply when it comes to MIQ, or the quarantine rooms, coming back into play, but also when you look or consider the new supply that's coming into certain markets, particularly the likes of Auckland, which is the brunt of that. I'll come to that more as we go along as well. By contrast, when you look at the major cities of Australia, you can see that they're way more ahead, so to speak, in more recent months, where they've been sort of travelling along those above pre-pandemic levels, with the exceptions of the larger cities of Sydney and Melbourne, of course. But they are starting to come back to the levelling playing field, if you like. And as that starts to continue that trajectory, we'll start to see that the nation of Australia will certainly be doing very well in overall numbers, as will New Zealand. So let's take a close look at why there is such, sorry, I didn't mean to make this a sore point, but this is, why are they very, and it's far be it from me being an Aussie to make sore points about bloody rugby either, by the way, so feel free to sledge me afterwards. It's the speed of recovery we're thinking about here, right? So just to give you some perspective in terms of where New Zealand is at, comparing to the two key cities of Australia. So looking here, Melbourne, Sydney versus Auckland and Wellington, and you can see that they're about, in essence, around 4 months behind in terms of timing, which gives pause and a degree of sanity to where performance is heading. And there's also those two challenges included there in that progression. That's also, as I mentioned before, the return of those rooms from quarantine and that additional supply that's coming into some markets as well. Again, focusing on Auckland and Wellington, we're looking here at, again, occupancy and the opportunity going forward in terms of occupancy retrospective to, again, 2019 levels. It's those weekdays, right, in terms of occupancy, and similar story to average daily rate. So as the opportunities, or as the source markets start to return from international markets beyond Australia and the like, these are going to be the biggest opportunities in terms of growth and performance. And I'm just going to look here now at Auckland as a focus on market class. And this is looking at, again, indexing for the first half of 2022, indexed again to pre-pandemic or 2019 levels. All of them are obviously shining in terms of average daily rates, all above 2019 levels, but it's a broad, consistent story in terms of demand. They're all being challenged across the board. And I'm just going to bring out Christchurch here as an example of that story as well, and a good example of where, you know, a city in waiting of international visitors to return. Yes, they're seeing peaks and troughs in occupancy around that 40 to 60% mark in the most part. Thankfully, there's the return of MICE and convention business to the brand new, or the reopening of the convention centre. So that's bringing some life back to the region, of course. But there's also, you know, a clear distinction between certain classes, luxury and upper upscale, and the mid-scale and economy. Fun enough, in the middle is your upscale and upper mid-scale rather, which is still sort of in that average daily rate. Interestingly, still just seeing consistent levels of 2019. Could be to do with the MIQ, but yeah, that's something we can have more of a close look at. But I just wanted to call out the destination of Queenstown in terms of where it's at with its timing. And it's obviously been welcoming the return of international visitors, particularly from Australia in the winter season particularly. But just looking at, if you look at the same point in time in terms of indexing to opening time with somewhere like the Gold Coast in Australia, so both share the synergy of being leisure destinations, very popular in their own nation. But you can see that Queenstown has really jumped out of the gate, so to speak, and looking very positive going forward. And the most recent time of that particular story was obviously in the winter school holidays, just recently when we saw the highest occupancy and average daily levels this year in just the recent weeks gone by. And looking at that building occupancy and how it was actually going over the recent months, over winter, you can see this is just looking from 1 month to the next, leading up to those winter school holiday periods. So you can see here from May, June and then July perspectives and how that occupancy is built. A big quick shout out to everybody who's already participating in the STR Forward Start program, because that helps to provide these insights, and also hopefully those who are participating are benefiting from those insights to make more informed decisions about how to make the most of how demand is shaping in those more obvious ones, but also those shoulder dates more importantly, where there's sometimes those opportunities can otherwise get missed. And again, focusing still on Queenstown and looking at how same time last year compares to this year. And the good news is that for the most part, dates are up and above, particularly looking in months going forward in the next 12 months as well, but looking just at the 90 days going forward as we are here, you can see it's particularly those the dates here in the short lead time, but also you can see the building of the spring school holiday periods is also starting to build nicely as well. And it is still following a similar trajectory to what it was last year. So it's a good base to build from. So these ADR results that I've been banging on about, how do we explain these? So where do they come from? What's going on there? So since reopening international borders, New Zealand's ADR has been responding to the demand of wide inflationary pressures, as they have been doing globally as well in other destinations, including Australia, of course. And that ADR component is doing all the heavy lifting, which is ultimately underpinning RevPAR results as well. They're seeing, for June, for instance, getting close upwards of past 90% in terms of indexing to where they were in prior years. So getting there. The ADR is underpinning it. So looking at the main 5 destinations here of New Zealand, you can see that there's different stories happening. The late comer, of course, being Queenstown, but obviously just recently, as I highlighted before, the school holiday period in winter holidays is really starting to see that now come to the level playing field of all the others. So why the variations? Why these different stories with each of these different regions? Well, the first part comes from a lower overall occupancy, largely being reliant on mostly domestic and Australian audience for the most part to date since reopening. But that is obviously steadily changing as we start to welcome more source markets internationally. And the great news is that occupancy is progressively building. We can see that when we look at the next 28 days. And already here, as we saw in June, it's already peaking at over 50% levels of occupancy, which is a great result. And then looking forward in terms of occupancy on the books, we're looking at here as a nation from the 18th of July, so last week, comparing New Zealand and Australia. And you can see here that New Zealand does trail countries like Australia, which ultimately has a larger domestic engine, so to speak, in terms of being able to support its occupancy levels in Australia versus a smaller domestic engine here in New Zealand. And if we break that down by market, this is a busy slide, but at least gives you a bit of perspective on those individual markets. All these, 3 of those 4 markets are all active in Forward Star, by the way, if you've got hotels participating in those regions. We're just about to launch Christchurch in the coming weeks as well, we hope, for those who are anticipating that launch, which is really exciting for us. And it's events and other things, other factors that are obviously, as I mentioned before, which are, for the most part, giving cause to some of these peaks and troughs. And, events like this one here in Queenstown come out with Snow Machine. Hopefully nothing like we had just recently with the Splendour in the Grass or Splendour in the Mud at Byron Bay recently in Australia. It was a bit of a shocker, but yes, hopefully a much more positive event for Queenstown coming up. I'm just showing you this slide here to give you some perspective in terms of a country like Fiji, which is obviously very reliant on international travellers. And that spurt of growth that happened when it reopened in December, it plateaued out and came down a little bit. Seasonality kicked in, typically of that time of year in February, March, but then it started to come back again, particularly from Easter and onwards. It's been seeing a very positive and consistent, more stable trajectory, which is a great story. We're just about to launch Forward Star in Fiji next week as well, which is exciting. Just finishing up, I'm just going to show you some final slides here. This is just looking again at market classes for both nations, comparing New Zealand to Australia. What I'm just focusing on here is this is year to date. And you can see when you bring in those earlier months, that ADR isn't as uplifting a story, but also by contrast, it's interesting to see that there's not a lot of variation in New Zealand compared to Australia. And again, it just drives home that message of that diversity or lack thereof in what's currently making up the numbers right now. Seasonality is another factor, as I mentioned earlier, and those winter months heavily reliant on those international visitations. And just finishing up, pipeline. So looking forward in terms of supply. Supply can be good, it's new, it's fresh, it's exciting, but it also adds to the availability of inventory and that bedding down and merging with the already current supply that's in market. The vast majority of it's in Auckland of over 1,800 rooms, which I showed in that video earlier, followed by Christchurch and Queenstown. So just over 2,500 rooms or thereabouts under construction currently. So they are coming, and that's currently where. So just to finish up, global performance is growing and increasingly showing confidence, as was shown in the earlier slides. Whilst New Zealand's timetable has got different starting points to comparison of countries like Australia, the performance is progressing, which is the great thing. It will reach a tipping point as factors see its recovery slow and plateau. We've got labour shortages still, is not just unique to New Zealand. There's inflation costs and just costs in general going up, which is not unique to you guys. It's something that's happening globally. Australia is also having a very, very tough time finding good staff, but also dealing with the inflationary and other costs that are going up. City by city reasons I talked about earlier in terms of how they differ from one to another. Profitability is still being impacted on current inflationary pressures, which I just touched on, and the outlook is being influenced by the recovery of international source markets, which will also impact supply and the average daily rate. So thank you so much. I'm going to hand over to Stephen. Thank you.
Cheers. Well, thank you, Paul. That was a tour de force, wasn't it? Talking about the performance of the industry. And I was reflecting with Gavin Full last night that us accountants aren't usually good at talking about the future. We're usually good at talking about the past. So it was great that Paul does the talking about the past and I get the opportunity to talk about the future. So this morning I'm going to talk about the hotel market in some of our main centres and the outlook over the next really 15 years, supply and demand. And of course, one of the key factors that influences that demand is our international visitor market, and it's always been that way through the development of the hotel industry over the past 30 or 40 years. And I'm going to talk about our international and domestic visitor nights in total in New Zealand. That's across all reasons for visit, including leisure and visiting friends and family, etc. So firstly, this is the outlook through to 2033. This is described as a current Horwath scenario. So this is not the most optimistic outlook, and it's not probably the most pessimistic outlook. I wouldn't even necessarily describe it as the most likely outlook, but it's somewhere around there. Let's just call it a base case scenario for the future. And it has the international visitor numbers returning to 2019 levels by around about 2025. That's a pretty well consensus view in the industry and has been the case for quite a period of time during the pandemic. We've highlighted there the Australian market, which is bouncing back early, as Paul said, especially into Queenstown, which is currently very busy with the ski season and very welcoming of the Australian visitors, and just slower recovery from the other international markets. The interesting thing, however, is to think about the period after 2025 and what is that growth outlook. So here we are slowing down the rate of future growth from international markets from what might have been the forecast pre-pandemic. And that takes into account the objective of value over volume and also the social licence to operate, the tourism industry in the regions of New Zealand, and increasing sensitivity about the carbon footprint of travel. This is the domestic market. As we know, the domestic market, whilst there was a lot of bumps on the road during the COVID period, generally speaking, domestic travel with New Zealanders not able to travel overseas did not suffer too greatly, and there was a lot of domestic travel to the regions in New Zealand. And the outlook for growth there growing at about 1% per annum from the pre-pandemic period through to the outlook in 2033. And when we combine international and domestic visitor nights, you can see the dip there in on the yellow line for the international visitors, the more stable domestic market, and the total in the grey line on the top. So in terms of those international visitor markets, the recovery rate, we've assumed faster recovery from Australia, USA and Japan and the UK, slower from Germany and China, slower to recover, not getting back to pre-COVID levels until 2026, and on average back to around about the 4 million visitors by about 2025. This slide was put up recently by Auckland Airport, and I think is really interesting, showing the forecast seat capacity expected into Auckland Airport based on the planning of the airlines through to the end of 2022. And we can see that there was quite a big jump in July, and that may be related to ski and also the Trans-Tasman, importantly. But another big uplift expected in November with longer haul travel, and that's also the US market, of course. That's a 43% uplift forecast in seat capacity in November. The China market is uncertain in this outlook. There's a little bit of seat capacity from China, but no real significant growth expected this year. And this was another slide from Auckland Airport, which just shows the international air connections into Auckland, anticipated as at December. The interesting thing about this is to look at the significant number of connections in the US and North America. 6 ports in the USA, plus Honolulu, and 9 ports in Asia. So it's definitely an indication of the Pacific Rim being important for the recovery of inbound into New Zealand. This information comes from Stats New Zealand and looks at the international arrival recovery so far during 2022 compared with the same week of the year in 2019. And you can see that this yellow line at the bottom is tracking very closely to that Auckland Airport seat capacity outlook. This New Zealand chart, of course, includes Christchurch, and it includes Queenstown, and you can see the uplift there as predicted in the seat capacity in July, and there'll be a significant component of that, no doubt, coming into Queenstown. The interesting thing is when we get to that November, will that significant increase in seat capacity materialise and drive that line further upwards? Indications are that it could well be the case. So now moving on to the Auckland hotel market. As we know, there's a significant supply increase expected pre-pandemic, and post-pandemic pretty well, while some of the projects are delayed, most of them are expected to still come through. So there's around about a 40% increase in supply from the 2018-2019 level through to around about 2023. The blue bars, which show the supply, are adjusted to eliminate the hotels that were involved in MIQ business, and the yellow bars, which is the demand side, have also excluded the MIQ business in Auckland hotels. So we can see that demand, of course, fell dramatically in 2021, but is now recovering in 2022. Because of the significant increase in supply, occupancy takes a longer period to recover. And we have assumed here that in terms of the Auckland region, that it regains some lost market share of visitor nights that was occurring in the period 2017, 18 and 19 as there was a constraint on available hotel room supply in the Auckland market. And we've also assumed that all of these new rooms are not going to simply be completely underutilised, and that therefore the Auckland hotel industry will regain some market share from other forms of accommodation, including private accommodation such as Airbnb. So another key thing to note here is that pretty well we're assuming that the supply increase in Auckland is over for a period of effectively 10 years in these assumptions. Then we move on to Queenstown. So Queenstown also is anticipated to have a 40% increase in room supply from previous levels in 2018, 2019, and we know that that's already happening. But in this forecast, the increase is assumed to be more staged over a period of the next 5 to 7 years. And as a result of that, as the demand, the yellow bars, grows and recovers over this period through to 2025, occupancies in Queenstown in this forecast rise to the 70% level and above more quickly than in Auckland. So whilst the supply increase is the same, of course the Queenstown market in total size and volume is much smaller than Auckland, and therefore with the international visitors returning to New Zealand, the available capacity can fill more quickly. Nevertheless, we are also assuming that because of this supply increase in Queenstown, that Queenstown also increases its share of nights in New Zealand, and also that hotels increase their market share. Christchurch is an interesting scenario, and in our modelling here is slightly different to those other two key markets, because we are assuming here that in Christchurch there is further room supply increase towards the back end of the forecast period. And you can see that the total demand, the yellow bars, also grow to a greater extent by comparison with the historical than is the case in the Auckland and in the Queenstown forecast. And why is that? Christchurch had not recovered pre-COVID its market share of visitor nights in either the domestic or international market compared with the pre-earthquake 2009-2010 levels of visitation. And this forecast assumes that by 2033 or 2034, 2035, Christchurch can regain that previous market share of visitor nights, and that's what this forecast is based on. If that is the case, then there is the opportunity or the need for more rooms in Christchurch in the long term, medium to long term, to accommodate that growth. I think it's a little bit of a pessimistic view to say that Christchurch could never get back. With Te Pai, with the international airport, with effectively a new city centre, it will be unique, fresh and new in New Zealand, and it's the gateway to the South Island. So this is a positive outlook for Christchurch hotel industry, and with occupancies in the 70s and into the high 70s, the opportunity for reasonable profitability. The key issue for Christchurch in the past has always been seasonality, and Te Pai does have the potential to make inroads into that problem of seasonality, but not forgetting that it of course was previously a convention centre in Christchurch anyway. And then Wellington. Another stable outlook for Wellington, not as exposed to the international visitor market, and with a new Te Kina Convention Centre to open in Wellington, the outlook is positive for occupancies and the outlook going through to 2033. We have not assumed in this forecast that there is a lot of new room supply to open in Wellington after about 2025. But the reality is Te Kina will be driving hotel demand in Wellington, and there probably is a case for more rooms in Wellington in the medium to long term. So that's a pretty positive outlook for Wellington. So in summary, what are some of my key conclusions in relation to the future outlook? Well, the demand outlook for international visitor growth after 2025, as we get back to the 4 million visitors, is a moderate growth outlook. That moderate growth means that the growth should be manageable and possibly arguably more manageable than we were able to achieve pre-pandemic, when there was strong growth in visitor numbers and we were creaking at the seams in many respects. It does assume an outlook that we are targeting value over volume, and it certainly looks as if in terms of yields that are being achieved by airlines, at least at the moment, and in hotels as well, that we are in fact tracking to value over volume. Whether that's sustainable over a period of 15 years, time will tell. In terms of the hotel supply growth, we're assuming that there's effectively limited new hotel supply other than what is currently underway in Auckland and Queenstown for a period of 8 to 10 years after that 40% increase in supply opens. However, there is opportunities for growth in Christchurch and Wellington and in the regions of New Zealand. So it's going to result in a greater spread of demand around the country, and that meets our tourism objectives as well. In terms of that hotel demand growth, it does assume an increase in market share of visitor nights in Auckland, Christchurch and Queenstown. Now you could say, well, hang on, all of those key markets you're assuming increasing in market share. It is possible for key markets to have an increase in market share, and for other markets to have a decrease in market share, but still have volume growth. And the Auckland recovery, it's the key market in New Zealand. It's about 1/3 of our total hotel market capacity. It's a slow but sustained recovery outlook for Auckland. So those are my comments, and I think I have kept to time almost. So thank you very much.